This is Alan Bush with ADMIS. In the stock index futures, we are seeing prices a little bit higher so far this morning. We did have some better than expected Chinese economic data in the form of a manufacturing index that did come in better than anticipated. However, this is being offset as far as the influence on stock index futures of rising short-term interest rates in China. There's some talk that China is interested in raising interest rates in an effort to cool inflation, especially in their housing sector. Longer term, though, it looks like this market will be supported by the Fed's ongoing quantitative easing program, where they are buying $85 billion in treasuries and mortgage-backed securities every single month, and it does not look like they will taper at least until the March policy meeting that takes place in 2014. So nothing has really changed as far as the accommodation from the Fed, other than that it will probably be extended. Over in the foreign currencies, seeing the euro currency higher, even though we did have some rather anemic economic numbers coming out of the eurozone. Also, we have the Canadian dollar coming under pressure for a second day. Yesterday, the Bank of Canada softened their rhetoric as far as tighter credit policies. This after about a year and a half of the Bank of Canada warning about the need to raise interest rates at some point. So that all of a sudden changing, a softer tone to their policy statement seems to be a rather major change in what they had been saying. So some pressure in the Canadian based on that, although I think it is likely to only be temporary. Also, we have the Australian dollar coming under some pressure. This most likely linked to interest rates in China being pushed higher. So I think that is the dominant influence, even though we did have better than expected Chinese economic data. But all of this is likely to be a temporary factor as interest rate differentials overall continue to favor the Australian dollar over the US dollar. And over in the dollar index, we did have another new 8-month low today. The economy here seems to be just gradually improving, but the dominant influence is the apparent unlimited quantitative easing, which is pushing interest rates lower, at least at the short end. And that is a very significant factor pressuring the dollar index. So looking for basically more of the same. The dollar index will probably continue to weaken. And credit markets, as the QE continues, this buying is supporting the treasuries. Also on the weekly charts, we have a recent top from last July coming in at 136 even. We're not that far from that point. And I think there's a very good chance, based on where we are on the charts, that buy stops could be hit above that point. So look for at least one more thrust higher in treasuries as QE continues to dominate that market. Once again, these are my opinions alone and are not the opinions of ADMIS or Archer Daniels Midland.
Okay, cool.